Yes. Okay, nice. So let's go. We talked about PMIs, right?
Yes.
Yes.
And PMIs are something important. I mean, if you look at the calendar, for example, I would just take, you see, Monday was holiday, Tuesday, there are a lot of OPEC is today, and US dollar manufacturing PMIs. Then there are some German financial service PMIs. So they're not high volume, so we don't really need them. But on Friday, I believe, nope. Well, we got some ISM service PMIs on Thursday, so we could take a look at the service PMIs from the US dollar, but the important thing is you have to read what it says, because it says released monthly on the third business day after the month ends. So basically, it shows the service PMIs for December, not for January, of course, because this was December
Yes.
and December the 3rd. So if it's December the 3rd, it shows for November. And basically now if it's the 3rd of January, it shows the PMIs for the whole December month. So it's 1 month backwards, basically.
So that PMI was showing that the PMI index was 69 at that table. So
Yeah,
what
you
you
see
can say that?
you
Yes.
see basically it shows, it's a leading indicator of economic health, so it's a
It
really
means
strong
bullish.
driver of
Yes.
economic growth. So what we can see here, the forecast is actually worse, right? So we see, okay, it seems that the service PMIs are decreasing, so the economy is kind of slowing down. What they want to say is the economy is slowing down, and we just want to make sure that we're all right, and that we can, how can I say? Here, for example, are the Indian manufacturing PMIs, and I'm just gonna search for the American here. But this is the manufacturing PMIs. We want the service PMIs. So there are no service PMIs at here. No service PMIs. They're coming out on January the 3rd, actually. So they should be here. What I see. Maybe let's okay, service PMIs, December 12th. This can't be it, this can't be it, this can't be it. Okay, that's kind of weird, because usually it should be somewhere in here, actually. But okay, you know what? PMIs are PMIs, so what we can do is actually look at the US manufacturing PMIs. Why? Because there is the ESM manufacturing PMIs today, actually on Tuesday, right? So what they say is it's also decreasing, right? And it's basically the same. It's a leading indicator of economic health. So we can now just open up the PMIs and just look what they have to say, right? So you get this PDF file here, and you can see key findings. They say output expansion muted as firms registered slower upturn in new orders. A slower upturn in new orders is bad.
Okay.
It's not good, and rate of cost inflation remains marked despite easing to softest since June. So there are some keywords, there are keywords which you have to pay attention to. For example, backlog of work rise at slowest pace for 10 months. So slow pace of work is obviously a bad indicator for economic health, right? And you just have to, this is just like one side basically, and you have to read through all of this. And basically what's important is for the PMIs, especially for the manufacturing PMIs, is how the work, how can I say, the circumstances are. So for example, if we read from here, right? Meanwhile, cost burdens continue to increase markedly despite the rate of inflation softening. That means inflation is going down, softening to the slowest since June. Efforts to pass through greater cost to clients were hampered by softer demand. Softer demand is not so many people are trying to buy anything, right?
Okay.
And as charges rose at the slowest rate since April, etc., 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 etc. So basically everything says slow. You see slow here and I'm improving. There is something maybe interesting, ongoing efforts to build safety stocks in a severe deterioration. I don't know what it is, vendor performance, improving conditions continue to lift the headlines. However, this is important. This is important. The rate of output growth picked up slightly to the fastest for 3 months, but was much slower than those seen earlier in the year. So the rate of output growth, so the manufacturing picked up slightly, but it wasn't as good as in the previous year. So in January, February, of course. So it's kind of slowing down, right? And if everything is slowing down, we have to kind of make a picture of it. And we already know that, of course, if we look at it and we say, we just make a picture because we can't really say how the numbers are going to affect it, but there is something called forward guidance. And this is what it is. Actually greater than forecasted is good for currency, which means if this number comes out better than 60.4, right? It will be priced into the US dollar, and if it's better, the dollar will rally. If it's worse, it will fall, right? And if it's coming out exactly at 60.4, nothing will happen. It's basically fair value. So if I show you this on the whiteboard, how this looks like, I can also show you this. It's called forward guidance. This is really a topic you can look for yourself. For example, Wikipedia here. So I will just send you the link in Telegram because it is important. You can just, it's just for information purpose. Look, forward guidance is a tool used by a central bank to exercise its power in monetary policies in order to influence with their own forecast market expectations of future levels of interest rates. So when news come out, this is basically what they do. This is basically how they price in something. So we have a time span, right? This is the 0 point, and this is the point where the news are coming out, right? So this is the time span basically. And you see maybe prices starting like here, for example, and prices doing sort of like this, right? And at some point, the news hit the market right here. And let's say we have like, what was the forecast? 60 or 61, right? So it's either 61 or 60 better, plus or minus. So it's better than 61. What will happen to the dollar? It will go up, right?
Yes.
But if it's less than 60, it will obviously go down. And if nothing happens, if it's, let's say 60.5, it's in the middle, right? Price will just go like this. And what they will obviously do is they will either or. This is the thing. This is what you mostly see on FOMC, right? If something is like, it's always priced in, they try to price it in because they try to price in the forecast. Let's say the forecast is 60.5, right? Then at this point, this is fair value because they hope that they get it correct, right? They get the forecast correct. And most of the time they don't, but this is the thing. They try to get as near as possible to the forecast. And from this point, obviously when price is going down, right? After the event, but the news come out actually positive, right? So let's say the news come out and price is going down fast and it's positive. That's your buying opportunity to at least fair values, not above fair value, but they will have to just price in back all this data, right? Because this was fair value 60.5 and price went to actually 60, but the forecast came out at 61. So they will have to bring it above fair value actually just to make sense of the whole market. And vice versa. For example, if the forecast is coming out at 61, right? I mean at 60. So, and prices going up at 60, the forecast is actually bad. So what they will do is they will just bring price down to fair value, or even worse, they will bring it below fair value because the forecast was actually worse, right? So this is obviously what they do. They try to make a prediction of the future. That's why it's called forward guidance, because they try to be on the right side. Obviously, everybody tries to be on the right side because actually nobody really trades the news except the big banks. I mean, retailers do trade it, but the big moves just happen because banks are actually taking a position. They try to say, okay, is it bullish or is it bearish, right? We don't know, but they make the assumption and we just have to trade the assumption. And what it's actually best is always trade towards fair value. So when news come out, we always want to trade towards fair value, means 50, right? Fair value is 50%. If this is 100, this is 0, that must be 50. So this is what forward guidance is actually about. Okay, so this was just like a little introduction. There is more to it, but this is like the, how can I say, the short answer to your
So
question.
actually, the manufacturing index shows the impact of this manufacturing must be in the steel sector and auto sector, like not all in all sector, right?
Yeah, you know, the PMIs are basically a composite, right? They're putting a lot of sectors into one to just, how can I say, just make a bigger picture out of it. Because if you look at everything individually, you will have a much more foggier picture than if you have everything together, right? If you add everything together and then make an assumption of what happens, then you get a better picture of the whole economic situation. Like, for example, we can say key findings in the Indian manufacturing PMIs, right? December sees substantially albeit slower rises in sale and output. In input cost inflation softens, weakest in selling prices since October 2020. So this manufacturing PMI wasn't actually too great, right? And if actually, this is the funny thing. This is what I was looking at, because if the PMIs are actually worse than expected, right, then this should have a negative influence on the rupee, right? It should be negative rupee. But what actually happened, I don't know. I mean, I can try to look for it, but I don't know where I can filter the currency out. I think it doesn't even have the Indian rupee here. Okay, but you know what? Doesn't really matter. I got another site. It's called Trading Economics. And this is a good site for fundamentals. You know, fundamentals are really important actually. And what you can do is here you go to indicators, and now you have main indicators, which are inflation rate, interest rates, GDP growth, etc., and business. And business is what we need. So we look for manufacturing PMIs. And then here we have Asia, there's India, for example. So now we get a chart, we get a line, because a line is always more clearer. We're more competent with lines, and we just take a 1 year look back from January until now. And we compare it to whatever country, like for example, the US dollar, right? We could compare it to the United States here. And we pick the same indicator, we take the manufacturing PMIs here. So, and now we see what is stronger actually in manufacturing PMI. So you see, obviously the US manufacturing PMIs are dropping a whole year, and the Indian manufacturing PMIs are actually rising, but they're dropping as well. So we can see the Indians are stronger in manufacturing than the US, right? And we can even put the timestamp on and put it like maybe from the August until now, and then we have a little bit of clearer picture. And you see they're already pretty low, they're relatively high. So we would like to be more bullish on the rupee. And look what this is like, okay, from December, right? But overall, the overall picture, if you look on the daily, the rupee is pretty strong. You see it. I mean, it's consolidating in a range. It's constantly bouncing off from 77 to 72s, and just was in a whole range from March 2000 since COVID, you know, since COVID, it was just in a range. But it's stable. You see the rate is stable actually. This is what's really important because I believe personally, right, your country is on a good way to become a, how can I say, a strong economic country. I mean, every country is facing problems, you know, like climate change and all this stuff. But I think in the long run, right, in the long run, we can be sure that your countries like Russia, India, and Asia, like China, Hong Kong, Korea, whatever, will have a bigger advantage than we in Europe, for example, because the Eurozone is a critical zone, to be honest, because even though it looks good over here, it might not look good in 5 years, you know. So emerging markets are something really, 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 what can I say? Something good. I mean, they have a lot of potential in terms of, I mean, India is famously known for coal, and coal is important and will be always a big part of the industrial sector. Okay, enough talking about fundamentals economy. I just basically wanted to show you, I wanted to show you how you can identify level 1 and level 2s. Okay, and this is real market data. So your market is kind of crazy. Like I looked at this and said, wow, okay, great, awesome. What is this candle, right?
If I look at spot chart of Bank Nifty, it was like nice, not like this.
So not the futures, you mean?
Yes, spot chart. Nifty Bank.
50, Nifty 50.
Nifty,
it was like this. But the problem is,
you can say Nifty Bank. This is Nifty. This is like main index of my country. But
this
Nifty,
here, Nifty 1.
No, Bank Nifty. You just write down Bank Nifty.
Nifty.
Yes.
Index. The problem I have is I don't have any volume here, so I can't say. You don't know if this is going to be bullish or bearish because you have no volume, right? This is a big problem. I mean, if we find Nifty 50, it's called.
Actually, Nifty 50 is my main index. Country's main index is Nifty 50, and this is collection of 50 stock. And
yeah,
Bank Nifty is
the biggest 50. Yeah, but you know, I need something with volume actually. So this looks actually pretty good. The SP CNX Nifty Index Futures. This looks good because this was the same candle as the other one, because this here doesn't look. Wait, I'm gonna save it up. I'm gonna save it to my watch list. Because it is the Nifty actually, the Nifty 1, of course, and this is the Bank Nifty. I don't know the difference between those, but you see,
this is collection of 10 stock of banking sector, and this is collection of 50 stock of all the.
Okay, so which one would have more significance? You have to tell.
Nifty.
This here or the Nifty?
Nifty, only Nifty. This is
only
more significant. Yes.
So this one is like more fugazi. This is not so good as this one. Okay, this is good because you know this is obviously traded on the NSE. This is actually your market, but you know, first of all, what I wanted you to look at for a long period of time is, of course, just volume, right? I just wanted to show you how you can trade the volume, the opening. You see, every time the market opens, it gives you high volume, right?
Yes.
Obviously. And, you know, sometimes you think, okay, the volume is red and the volume is green. It's kind of mixed, right? So we always have to be identifying where is price and is it logical? You know, like for example, if the candle is green, you want to sell it, but you don't want to sell it at a low price. If Nifty is high and it is a green high volume, if it's at a measured move, right? If it's at a one-to-one measure, like if it is somewhere here and the volume kicks in, this is a good level. But if it's at the bottom edge and it's green, you can't sell it. So for example, I put the chart back on, right? Imagine this is at the bottom edge, right? would you have any problem to buy this downtick here, for example, right at the open? I think not, right? Because price is kind of low. I'm not saying it's 100% low, right? But you can just look at this level and look to the left here and say, okay, there is a high volume candle. Where is another RGL? Here is an RGL, right? And you just say, okay, this was another open. We're trading above it, above it, above it. We're not coming close to that level. Okay, I agree with that. Maybe you could mark out the follow through. You have to make a picture of it. You know, this is high volume. This is slowly fading. This is fading. But if you look on a 15-minute on a macro chart, right? If you look at it on a macro chart, you get a bigger, better picture. Like you take this close here, and obviously this makes perfect sense now, right? Because you have this macro level here, this macro volume. You mark out the close of this opening. You see it trades above it, above it, above it. It pins it here right at the open on a big, large volume, and you say, okay, you know what? It's likely going to be a buy side bounce, and obviously, yes, it is a buy side bounce. But we also have to make sure, what is this level actually, right? What is this level? Is it a level I want to deal in? If you take the swing low and swing high, right, you can say, well, it depends how you take it, but if you take it like this, I wouldn't count this in, but I would take the swing high, the swing low. It is somewhat of a 50 pullback, right? You can even take the swing high, the swing low, because this is not really a break to the upside. It's rejecting these highs, right? This is more like a level. This is what I mean by level 2, actually. This is the best exercise. And you would agree, right, that this here is a bracket. A bracket is basically just a level 1, and a level 1 is a normal swing low, swing high. So if I just put my indicator fractals on, just put it on and put this in green and red, whatever, you would agree that this is a swing low, right? And this is a swing high.
Yes.
And the 50 of this range would be in here. This is the 50. So how Ray is identifying the level 2 is, a level 1 is just a swing high, a prior swing high, a prior swing low. And a level 2 is a prior swing high or prior swing low rejected, okay? So if you see something like this, you might think this is a breakout, but you have to see the follow through. It has to hold above here, right? So it has to do something like this here, this type of stuff. It maybe pins back down, but it has to reject this top line here to be another level 1, because then it creates another level 1 and it comes back and it creates just another level 1, right? So there's no level 2, but because this here is coming up and rejecting back down into the 50, this becomes a level 2 commercial. So every time price is rejecting the high and is coming back to the 50, your job is to, of course, yeah, this is the squeeze trade, you know, this is the squeeze for the higher high here, but you always think about this 3 times the lady, right? This is the 1, this is the kind of the 2, and this is the 3 point. So you always have to be in, you always have to think about commercials accumulating, right? They don't say, okay, it's just one price. It's an area, right? It's always about areas. It's not about one line or something. And you obviously see this candle here rejects back into the 50, right? In the same candle, if we go to the 5 minute, I hope I can go back that far. Yeah, if we go back here, you obviously see, yeah, they went for the squeeze trade here, but before this came up, right? This came down below the 50. So if you think about the whole auction process, right? If you think about the whole auction process, and I'm just deleting this here right now, and this here, and just draw another line in here, just kind of point here. If we're above the 50, right? The buyers from this low here are in control of the market. The sellers are weak-handed. So they will get squeezed. But then if the commercial comes in and rotates price back below the 50, like here, for example, right? This here, like once we break these swing lows here, these sellers have a little bit of a hard time, you know, because they are underwater now. And what happens is, yeah, price is actually rejecting back from this. You can say, yeah, this is the RGL, you know, possible because it's the closing price and the volume is kind of increasing in this area, you know, see here a little bit of increase in volume, and then it opens aggressively to the upside. It takes out this level 2 liquidity, because if you think about this now, this becomes the level 2, right? And it closes red below the 50. So what you're going to do is you wait for the next green candle, or you wait for the break. You can actually sell the breakout of this RGL, because a break of an RGL, once it's below this level, it must be a sell. It can't be a buy anymore. And even if it breaks this line here as well, you can just be a seller. And look, even if you would have sold this retest, right? It's the same day basically, or the retest of the 50. I mean, it's all in the same area, right? Here's the 50. It's the order block. You can use everything, really. You can, you know your stuff. You know, if you know your stuff, you can trade everything. You have the 50 here. You have the order block here. You have the RGL here. It's about the picture, right? And once you see that, you say, okay, where is my measure? So if you take swing high and swing low, this is your measured move, right? This is your take profit area and a potential buy trade somewhere in here. Not saying it's exactly here, but this is the point where you want to look at price. And look what happens. We get a high volume down candle, right? This is high volume, but we want to wait for the 1, 2, 3. Oh man, hold on. We want to wait for the 1, 2, 3 fade. You know, if you see the first volume, you don't want to fade this one. You never want to fade one. Never, never. You never want to fade the 1 point, because it will likely have follow through. You know, if you miss the trade, you miss the trade, but never fade one. Fade, you can fade actually 2, because you know sometimes it's hard not to fade the market. I'm struggling myself. I'm struggling myself to not fade the market, which is kind of hard. But you see this is a decline in volume, right? You obviously see it, right? I mean, we had this topic over and over again. Like, it's nothing new, but this is what I'm talking about. 3 times accumulation. And look what happens. You get the first volume. What happens? It gives a little buy side bounce and it comes back. And we just watch the close of the candle, right? So look what happens here. Nothing really, right? So we're not concerned with this one, but I mean, we can fade it and maybe we get a scratch, you know, maybe we get a small stop loss, whatever. But look at the third buy, right? The third buy is the buy that usually goes. And then, of course, the meeting is ending soon, okay? But I mean, now you have your 1 point, and once you get your 1 point, this becomes your RGL, right? Because it was the last high volume actually. So you can actually make a picture around this and say, okay, you know what? I had my 1, 2, 3. I faded the lows, you know, I faded the lows, but I only faded this one or this one. Personally, I would always wait for this one, for the last one, because why did I want this one? Because it was, if you take this swing high, this swing low, it doesn't matter which swing high, which swing low you take. This was the closest to the measured move, right?
Yes.
And now you can look to the left and say, okay, do I have something to work against? And yeah, you have, because look, these are the last 2 down candles prior to the up move, right? So why would you buy here, right? Why would you buy here if you see there's this series of order blocks, or what Ray calls catalysts, right? You see, it doesn't make sense to buy this one, and it doesn't even make sense to buy to this one. So you say, okay, I would like to buy here with a high volume, and look, you get the high volume and you get the trade, you get a 50 pullback, because if you take this swing high now and this swing high and this swing low, you actually get somewhat of a 50 trade, not perfectly, but you see, it is a half back trade back inside this order block here, of course, and you can actually delete this RGL, this RGL, and you see, now your trading suddenly makes kind of sense. And this is a 5-minute chart, man. This is like one day, this is the next day. I mean, I believe personally, because your market is not open all the time, I believe you should focus on small things like volume. You can rely on order blocks, but rely on order blocks at logical levels, you know. This is what's important, in my opinion. And of course, the 50s, the 50 trades and RGLs, higher time frame RGLs, all this type of stuff. So look, let's get a little bit of, let's clean up a little bit. Let's clean up a little bit. Let's clean up, let's clean up. I will just mark, I will leave the order blocks, okay? Because I think order blocks are very easy on your eye, right? Even on my eyes, and I will mark the RGLs with pink lines. The RGLs with pink lines. So this was the first RGL which we did not fade. This was an RGL as well here. So let's mark it out. I know it doesn't make too much sense, but it makes a little bit of sense because look what happens, right? Price is trading up. You could potentially buy this again for a squeeze of these highs, because this is a level 2 rejection, right? From the bottom edge. You don't even need to see value or something. Just because price is rejecting back and above the 50, the sellers are in the weak position. You see?
Yes.
There are here, this is the higher hold basically, and higher hold is actually the squeeze trade. And the squeeze doesn't mean it has to go for a measure. The squeeze is just taking the liquidity. And when it rejects back into the range, you know, okay, maybe there's a commercial seller sitting up here, right? So I have to be patient. And once you see that price is coming back below the 50, you don't want to buy it anymore because you're on the weak side, right? Price could just take the low now. And this is what we want to avoid. We want to avoid buying lows and selling highs because it's a dangerous job. We just want to buy lows and sell highs when it's at a guaranteed premium or discount, and this is the measured move. So like I said, if you take this swing low, this swing high, look at this measured move, right? It's perfect. Literally, it's perfect to the tick, and it's at a logical level. It's on high volume. It's the 1, 2, 3 fade. The setup is just brilliant, you know. And if you take this swing high and this swing low now, your measured move is right on the RGL. This is your take profit area, and look what happens. You take profits a little bit too early. Doesn't really matter. You take your profits here. It hits the order block. You can say, right, let's look at the same example, right? Failed auctions and successful auctions, basically. You know that, right? You know what a successful auction is and a failed auction is. A failed auction is when price fails to go above it. So this is what ICT calls as a failure swing. I bet you heard that, because yes. ICT has two definitions of a market. He says price is doing something like this, and then price is doing something like this, a stop hand, and then it goes down, right? So this is a stop hand, but he doesn't explain the narrative, why this is a stop hand, but I just told you what it is. What is this? Can you tell me what this is?
This is
a commercial, right? This is the commercial trade. This is where the commercial takes his trade. And then there's something, when there's not enough volume, this is what ICT calls the failure swing, when price fails to rotate above the high and then just goes down and breaks market structure, right? And this is a failed auction because they didn't have enough volume to take price all the way up here. So they said, okay, you know what? If this fails, I want to be a breakout seller actually at somewhere in the middle of this point. Even better, when this rejects and comes back to the 50, then I want to sell it again, because now we know, okay, they didn't have enough volume and we can start to go down. So basically, ICT has these two concepts. I remember them pretty good because I studied everything what ICT said. I studied all the 12 months, you know. And I mean, I even remember now. So, I mean, it's kind of hardwired in my brain, but this is what I mean. This is what ICT teaches you, but he's not teaching it in full, how can I say, in full detail, right? He just says, well, this is a stop hunt. Yes, this is a stop hunt, but why is it a stop hunt, you know? How can I trade this? How can I take this trade? And should I take this trade? Should I take this trade? Because this is also a stop hunt. No, this makes a higher high, but it's not a break in market structure because price is coming down all the way to the 50 again. So you can't classify this as a break in market structure. This can't be a break in market structure. It must be a stop hunt, because a break in market structure must be, of course, this is high volume, but this is high volume because it has taken the stops, and you see the follow through is not really there. So you see there is already exhaustion coming in at a high price. And if there is exhaustion at a high price, you can say, right, maybe I can try to squeeze a sell into this order block here if you're aggressive, of course. This is the thing. Some people have an aggressive trading style. Some people are more passive, you know, and you have to figure out for yourself what your trading style is. But let's go back.
Yes.
Back to the topic. Look at this measured move, right? Imagine you saw this failed auction. You would try to sell the BSG squeeze trade somewhere below the 50, of course, at the 75. So basically, you would look at the close here and say, right, failed auction below the 50, below an RGL, retest of the RGL here. And I didn't make this up. Didn't make it up because I just draw the RGL here, right? It is the RGL. I can't do nothing about it. You say, right, I'm selling it for a measured move. Where is the measured move here? Look what happens. Volume, bounce, 1 candle, 2 candles, 3 candles, market closes.
Yes.
RGL, look, same thing. And this is just from left to the right, of course, right? And the meeting is ending in 1 minute. I don't know, is your market open right now? Not right, it's closed. Oh no, it's open. It's actually open, right? It's open until 10:55. 10, so 1 hour basically. It's 1 hour open, right? Okay, nice. So we can look at this date today, maybe like for the last 30 minutes, you know, because my markets are doing nothing actually. Oh, actually it did. Look what happened. I mean, it's nothing special, but do you recognize the same pattern on every market? Look, this is the high volume where it came in, right? This is the high volume candle. This is the close here. I will just show it on my pair because I might trade this. I'm not sure, but what I want to see is the one fade. You see rejection of a level 2. This is a level 2. It has to be the level 2. So we just draw a box here. We just draw a box on the level 2. But you see, if I take the swing high and swing low, we're not below the 50. So I'm not even, we went below the 50, but we're now above the 50. So I know, you know what? Maybe we can fade the high one more time. And if we fade the high one more time and reject it because, oh, this is a measured move. So maybe I should just take the box up here. I'll just do a screenshot because I'm always doing screenshots, you know, of my trades. Because this is like the gold screenshot I took previously. And then I can look back at gold and say, right, what happened? Well, basically nothing because it just violated this order block here. And this is the thing with ICT, right? Look, I thought this was an order block and look what happened to this order block, right? It rejected here